Good morning, everyone, and thank you very much for joining me. This is our first webinar of the week, the morning market review. My name is Russell Shaw, Senior Market Specialist at FXCM. My email address, rshaw@fxcm.com, and if you need to contact me during the day, I encourage you to send me an email to this address. Today is Monday. It's the 25th of April 2022. Just going to bring up our high risk investment warning. I want to just let you guys know Wednesday is a public holiday here, so just be aware of that. I'll remind you guys tomorrow. Hey Zanetta, good morning to you. Nice to have you in the webinar. Thank you everyone for joining. All right, here's our market commentaries disclaimer. I'll keep this on screen for a few moments. And just our references. So we'll do some analysis in MarketScope 2.0. I want to start by reading the article from CNBC regarding European markets, and we'll take a look at TradingView. There's something interesting I want to show you on TradingView, which would be this chart here. But before we get into that, let's just go through the hey Rob, thank you very much. Hope you had a good weekend as well. We'll do another podcast tomorrow. It's I usually do it with Nick. Nick's away today, so we'll get the next one done tomorrow. All right. Let's just go through the news here. The headline reads: European markets are set to fall at the open. France's Macron to be re-elected as president. Okay, European stocks are expected to open sharply on Monday as the sell-off in global market continues into the new trading week. Investors in Europe will also be digesting the projected result of the French presidential election on Monday and monitoring the latest developments in Ukraine. France's Emmanuel Macron looks set to have comfortably beaten his rival Marine Le Pen in Sunday's election, securing a second term as president on his pro-business and pro-EU agenda. Official results showed centrist Macron gaining 58.5% in the second and final round of voting. Le Pen of the nationalist and far-right National Rally Party has almost 42% of the votes. European investors continue to monitor developments in Ukraine as Russia's invasion of the country entered its third month on Sunday. The conflict that has killed thousands and led to the worst refugee crisis Europe has seen since World War II. The war will end only if Russian troops fully withdraw from the country, Ukrainian Prime Minister Denis Shmyhal said. Asia Pacific markets fell sharply on Monday following a sell-off on Wall Street on Friday. US stock futures fell on Sunday night amid a 4-week losing streak for the Dow Jones Industrial Average as investors assess the likelihood of rising interest rates. Wall Street is also bracing itself for a stacked week of earnings, including reports from major tech companies such as Amazon and Apple. Earnings are set to come from Deutsche Börse, I hope I pronounced it right, Philips and Roche on Monday. Data releases will also include IFO's latest business climate survey from Germany. All right. All right, let's take a look at this chart over here. I found it quite interesting. Let's just maybe zoom in a bit more here. I'll tell you exactly what we're looking at. All right, so the candlesticks in the top chart, in fact, let's do this. I think that's better. Okay, so the candlesticks in the top chart are the US 2-year. The US 2-year yield, so it's the 2-year bond, and you can see the yields since 1989. This black line over here, that's the Fed funds rate. That's the Fed funds rate. This RSI here actually belongs to the S&P 500, which is this bottom chart. So, okay, so what we have, let's go all the way to where we are right now, which is over here. And you can see the 2-year yield is sitting at 2.6%, and the Fed funds rate at 0.2%. Okay, so it should be, I think, not quite sure what the 0.2%. Okay. Let's just understand the relationship between the 2-year and the Fed funds rate. You can see that the relationships, the correlation is very strong. The 2-year is a good proxy for where the Fed funds rate is heading. So the current spread between the 2-year and the Fed funds rate is, you can see, fairly significant. The inference there is that the Fed is very much behind the curve, very much behind the curve. If we have to go back, it looks to me as if the Fed funds rate clearly always lags the 2-year, but this looks quite extreme, the gap here. I'm just trying to see if we have any other extremes. Even sort of 1994, not quite as extreme. So the idea here is the Fed is seriously lagging behind what the US 2-year is suggesting. That's why there's this huge swivel, not so much in policy. The policy has been hawkish from the beginning of the year, but there's a swivel in how aggressive the Fed's being. They looking like they have to be aggressive because to close this gap here. So let's say there's 50 points in May. Let's say there's 50 points in June. You know, they're still way behind according to the 2-year. So all of a sudden now there are talks of 75 basis point. And the reason for that is, well, you can really see how the Fed's lagging here. Now, that's only one scenario. I would suggest it's the most likely scenario. There are other scenarios, say over here. This is quite an interesting period here. Why is this such an interesting period? Is because the 2-year pulls away from the Fed funds rate, but then actually pulls back down. Okay, so the one option, of course, is for the Fed fund rate to move up, to catch up with the 2-year. The other option would be for the 2-year actually come down towards the Fed's funds rate. So the question to ask is, has the market got ahead of itself, or is the Fed lagging? Those are the two scenarios that I see. At the moment, the thinking is, of course, that the Fed is lagging, considering how wayward and out of and sort of out of kilter their inflation is with their price stability target. I think though that we've got to be very careful with using these type of charts because there is something called a time period bias. And a time period bias assumes that the factors, the underlying fundamentals, are similar between the periods. So would the 1994 sort of increase be similar to the 2022 increase? I would suggest there are important differences here. And I think that the most obvious difference is, of course, the possibility of stagflation. Unfortunately, I don't have this series going back to the early 80s, the 70s, because that would be a really good period to look at, because that was a stagflationary environment with 1973, the first oil shock, 1979, the second oil shock. Because there is this risk of stagflation, okay, there is a real probability, I'm not sure the probability is particularly high, that the two-year might be too high. In other words, what is the probability of a policy mistake here? And I say the probability of a policy mistake here has escalated because of supply-side economics, supply-side shocks. Does the Fed have the capacity to raise rates? Now, if your answer to that is yes, well, then they're lagging. Okay, if your answer to that is no, then the two-year has overshot. Okay, so it really comes down to the your perspective here, and we want to just see what the how this plays out. So Rob's asking a good question. What's the green vertical lines, and what's the thinking with the S&P RSI? So that's exactly what we need to look at next. The reason that I've put up the RSI here, wait a second, let me just double check. This is actually a rate of change. I'm begging your pardon, Rob. It's not an RSI. It's a rate of change. It's a momentum indicator. I beg your pardon. Okay. So the idea here with this this rate of change. So what I'm looking at is the momentum in the risk markets when we have these spike ups in the yield, when the Fed's funds rate is playing catch up. And what you can see is between these green verticals, the momentum of the S&P moves down. Next one, momentum of the S&P moves down. Next one, momentum of the S&P moves down. Okay. Next one, momentum of the S&P is pretty flat here. Okay. Now it doesn't mean that when we're talking about momentum, it doesn't mean that there is a downwards move. It just means that the stock market's moving at a slower pace. So, for example, although there's kind of a sideways momentum, yet it does move up. There's a lower momentum, yet it does move up. Okay, but the point is the rate of change becomes quite flat. Now, why is that important? Is because the rate of change, okay, since the for us, the rate of change for us since the 2020 low, after that pandemic low, has been superb. If you've been a bull since the pandemic low with the risk markets, you've done particularly well in your investments. And the reason for that is because you have had a really strong momentum behind you. Let's put in another vertical, so it would be around about there, and let's just change the color. We'll just change this one to a blue. So so the momentum has really worked in the risk market. If you've been looking to sort of buy the dip, in hindsight, you know, buying the 2020 low was terrific. However, you can see that the momentum now is starting to decline. So we kind of peaked over here in terms of momentum. Is coming down. This is just to give you an idea of the settings here. Because we're looking at a monthly chart, I've just got the length of 12 months. So we're looking at the momentum over 12 months. It's dipping now. what I would suggest is that if the previous cases hold, then of course your risk market is going to probably struggle in terms of momentum. I wouldn't necessarily say that we're going to see down prices in the equity markets. That's a different analysis. That may be the case, but that's not what this analysis is suggesting. What this analysis is suggesting is that the momentum is going to decline quite a bit. So that is now very interesting, because if the momentum is going to decline in the risk markets, where's it picking up? So that's I've got to do some other sort of analysis here, but the idea is we want to try and look where the relative strength is, and that obviously becomes now a part of our watch list. Can we take advantage? Can we exploit where the momentum's picking up? I was thinking, well, can we put the US dollar over this? And I decided we probably couldn't, because the US dollar in of itself is a pair. It's a pair. So you'd look at euro, US dollar, pound, US dollar, loonie. So you'd have to do some sort of relative spread analysis. And then, so I don't think that just looking at the 2-year and the dollar is all that insightful. So this is a start of what we'll explore for the rest of the week. I'll try and build on this. But the idea here is you can certainly see that the momentum here is it's already coming down, and as long as the Fed is chasing the 2-year yield here, we're gonna probably struggle with the momentum there. So that's something that we need to keep an eye on. Now, I want to again reiterate, what's the time frame we're looking here? The time frame we're looking at here is a long-term time frame. We're looking at a monthly time frame. We've gone all the way back to 1990. Even before that, we went back to 1989. But what's happening in the short term? So for sort of investments, if you've been investing since the 2020 low, I expect your equity investments would have done particularly well. What about trading? What can we say about this in the short term? This is where it gets really tricky, because if we go down to the daily chart here, all right, now I do want to bring in an RSI. Let's get rid of these guys. Okay, let's bring in an RSI here. All right, so the idea here is, are there pockets of being overheated, overbought? So this is interesting. The US tier on a daily chart has moved back under 80. If you take a look at it on a weekly, still highly elevated. So sort of the daily, weekly timeframes that I would suggest, that there probably needs to be some sort of peak here. I think there probably needs to be some sort of peak here, at least in the sort of near term, because we are really moving to a point where it's getting really overheated. If we go back here, let's just see, pulls back there, pulls back there. Let's just see this on a daily. Okay, so overbought here, overbought here. The point is that the two year yeah seems to me to be a little overextended. Interesting that the daily is not quite as overextended where I thought. If we go through to our US 30. Okay, so now we'll bring up the Dow. Okay, sorry, I'm just taking a look here. So on the daily chart, the RSI now has moved below 50 on the daily, moved below 50 on the weekly. That's weak. Okay, this was weak. I wanted to see perhaps if we were oversold here on the RSI. So the thinking there is, are there short-term opportunities? I would suggest that we're probably not in an oversold period just yet. There could be some more pain to come here. So what I'm looking for an oversold position on the equity markets. I'm looking for an overbought condition on the yield side. And if those happen at the same time, some sort of reversion to the mean, to kind of it's almost like a pair trade, you know. So you'd want to see the yield come down, you'd want to see the equity move up. I would suggest that we're not quite there yet, which is a surprise to me given the sell-off on Friday. Nevertheless, we certainly need to be cautious. All right, let's bring up some of market scope. Let's take a look at the dollar here. Okay, so take a look here at the dollar. We've got the dollar moving to an overbought condition here. Okay, go back to the euro over here. Euro still got some to move. Let's just go through to pound. Okay, pound coming oversold. Okay, so we've got dollar overbought, we've got pound oversold. I'm going to make a point now. I just want to do a few more checks here. Let's just go through to US dollar CAD. This should be overbought. No. Okay, it's very strange. US dollar Japanese yen. Okay, some froth there, but this has been really sticking there for a long time. Let's just go back to the US dollar pairing here. All right, I want to go back to our trading view chart. I want to bring back the 10-year. Okay, so this is more what I'm expecting to see. So here you can see the 10-year is starting to push down on the daily. We go through to the weekly chart here. The weekly still overbought. Okay, it's needing to normalize. The 2 years don't seem quite as frothy as the 10 years. So, but the fact that the 10 years are showing froth and the greenback over here, the fact that the greenback is starting to show some froth as well, to me suggests there has to be some sort of normalization. I think that the greenback has run very hard, it's been very quick over the last 3 weeks. It's put the dollar in an overbought condition. That means that the longs over here, I think, are pretty much going to look to be taking profits. So here was a good signal there. Here was a good signal there. So all the longs that bought, it's moving up to sort of an R2 area. We are overbought on the hourly. Okay, we're overbought on the daily. We're overbought on the weekly. I think the dollar, okay, has probably reached pretty close to its apex here. So the idea here of although the US dollar certainly is on our watch list, because the Fed is so hawkish. It has to be so hawkish because we can see how far behind it is from the 2-year. Unless the 2-year, unless the market's got ahead of itself on the 2-year, but it looks like the Fed is playing catch up here. I would suggest that that supports dollar, but in the near term, I think there is a risk here of committing ourselves at a time when there's going to be profit taking, okay, by dollar bills. So I want everyone just to be cognizant of that. Now, if we go back down to the sell-off on the markets on Friday, so let's just bring up the US 30. Okay, it just seems it's overdone. It just seems it's overdone there. We'll take a look at the NASDAQ. Okay, again, just looks like it's overdone here. So we've got dollar looking overextended. We've got the, let's go back to the yield. Yields here probably pulled back. The yields have started to pull back on the hourlies. Let's just take a look here. Yeah, so the yields are starting to pull back on the hourlies. I think that dollar moderates. I think there may be some buy the dip mentality coming through. Let's just take a look at the DAX as well. So you've got these news headlines saying that European markets due to open softer. I think that there is a potential contrarian opportunity here. Now, if there's to be a contrarian opportunity, we want to see the EMAs cross. Okay, they need a cross. The stochastic has already crossed. Okay. Now, if we get those two crosses, it doesn't really mean anything. Okay. It means that there's still momentum that has to show it up. Okay. The signals in of themselves are not going to make the contrary strategy. It's the momentum. In other words, is the market looking at a do the market think the sell-off's overextended, and are they going to try and buy that dip? Now, again, it's a very risky type of strategy, because we take a look at the trend is down. Okay, so the trend is down. So we've got this looks like a bear market rally into a 62% retracement. We spoke about that on Friday. I think that the likelihood of a long-term push down here certainly is something that would be in line with a lower momentum on risk markets, which is exactly how we started this this webinar. But I think that the short-term picture here is probably overextended to the downside. I think that we do have a pressure to go downwards, but not before some sort of maybe mini play there, and the market participants try and take advantage of some sort of oversold condition. So let's be also aware that Apple's coming out this week, Amazon's coming out this week. Depending how those results are, it could make for a contrarian type of move in the market. So I think that's how we'll start the week as sort of a base case. The idea being that yes, we're in an overall bear market. Going short now probably has a skewed risk associated with it, because it looks as if yields are pulling back. It also looks as if the sell-off has been overextended. If we get some sort of bounce off of the sell-off, I think that sets up the next leg down, because Fed is playing catch up very aggressively. So that's where we are at the moment. It seems to me dollar, whilst still seeming to be a very good long-term play, probably also needs some sort of moderation here. Let's just end off with the monthly for the US dollar. So let's just go here. All right, so take a look at this. Let's just zoom out. All right, so this is a monthly chart for the dollar. It's in zone 1, but what's the real interesting part for me is the Bollinger's. Okay. Bollinger's pulling away from one another on a monthly scale. That, I think, is something that needs to be watched. It can prove to be very significant. So take a look here. Here is the dollar pulling away down. Here is the dollar pushing upwards. Okay. Then the bottom Bollinger plays catch up and turns up, and then this is a monthly chart, remember. Then you have a terrific move in the US dollar. It looks as if this is something that we should be watching for. If the central bank carries on being as hawkish as it needs to be to catch up with the US 2-year, that could develop this trend further. Again, I want to just reiterate, the longer term chart, whilst it will certainly influence the shorter term chart, it's the shorter term chart right now that seems to me a little overcooked. It just seems a little overcooked. So what does it mean for us? Just kind of I think it means that we got to be quite discerning here, right? We've always looked to buy dips. Okay. So right now, I think we are somewhere here. Okay, I don't know where the true top will be, but we must be closer to the top than at the bottom here. So buying over here, let's just say we buy right at the top. Well, that puts a lot of pressure on us on the pullback, even though we're probably on the right side. So we want to try and get it as close to the dip as possible. Go back here. This looks really extended. So some sort of dip as the yields moderate. The yields need to moderate. They've run too hard, too fast. If you go through to the, keep saying the final chart, but if we just take a look at the US 10-year over the week on a weekly chart, it's too fast. It's 7 weeks, 1, 2, 3, 4, 5, and it's pushed this RSI very much into the overbought territory. It's just, I think, a time of when the news is coming out and saying everything's negative, when everybody's turned negative. That's probably a time to turn contrarian. So we'll use that as sort of a base case, and we'll see if we can build on that. All right, so I know there's a little bit of sort of umming and ahhing back and forth, but I hope that sort of the base case has been made. We'll explore it again tomorrow. Wednesday, we won't have a webinar, but then we'll have a webinar on Thursday, Friday again. All right, if there's any questions, please go ahead and type those through. All right. Thank you very much, guys, and I will chat with you tomorrow morning.